So today we're going to take a look at the entire history of interest rates, how this works, and whether it's a good thing or bad thing, and whether it can actually pay massive dividends and lead to success in business, countries, economies. And obviously for you, it's really damn important that you understand how interest rates work, because smart people pay interest. And no, actually, that's not true. Dumb people pay interest. Oh, actually, that's not true. We're going to really get down to the honest truth. But there is an old adage and saying that says the wiser person is receiving interest and the unwise person might be paying it. So we're going to break this down in the history of interest rates. Let's get going. So interest rates have been a part of the economic systems for thousands of years, not just the last few hundred with capitalism, but thousands of years. And they've been used as a tool for managing economies, encouraging growth, and controlling inflation. For example, Alexander Hamilton. You've heard of that big play, Hamilton, about the life of Alexander Hamilton. Super fascinating guy, and really kind of the father of the Fed that controls interest rates in the United States. He absolutely came up with this entire idea of the United States of America having a national debt that could be used to finance the government and get things moving forward. It was very vital and important, and to incentivize people to invest in government bonds and have this national debt. Of course, that meant those bonds would have an interest rate that would be paid back to those bond investors. And boy, there's been some crazy history, but the bottom line is the United States would not exist without the power of interest rates. Now let's look back in ancient times. The concept of interest rates dates back to ancient civilizations. One of the first is the Sumerians. They lived in Mesopotamia in the Middle East around 3000 BC. And they were the first civilization to use a form of interest which they applied to loans of livestock. Maybe they had a lot of sheep, maybe they had some cattle and grain so that they could grow food. And when you don't have all that money up front to buy those things, somebody lends you money, you pay them back interest. And it was only later that interest actually started being applied to silver and other precious metals, because they weren't dealing with paper and ones and zeros and numbers like we do today. So then, after that, the Middle Ages come, and during much of the Middle Ages, you had the Catholic Church that condemned usury, and usury being charging interest when you borrow money. And so the practice of charging interest on loans was viewed as a quote-unquote sin. As a result, lending and charging interest was often left to individuals outside the church, which in many places meant that there were Jewish lenders, and they were very good with managing money, etc., etc. Then you have the Renaissance to Enlightenment era. And during the Renaissance and Enlightenment, as commerce and trade grew, so did the practice of lending money and charging interest. And then this idea of a corporation. The East Dutch Indies Company was one of those first corporations that came out, and they would use debt and interest rates to be paid on that debt in order to get investment in their business. And so was interest rates a very positive thing? It was, in terms of people's ability to create businesses and products and services and technology and improve the overall quality of life of human beings across our planet. So lending and interest rates as a whole has been very prominent and very key to the growth of the modern economies that we all enjoy in the year 2023. Now, 19th century to early 20th century, we get these central banks emerging to manage the money supply for major countries. And so they manage this money supply and they stabilize their respective economies. And then in 1913, the U.S. creates the Federal Reserve, which began to actually adjust the discount rate as a way to influence economic conditions. So they would have this discount rate, and banks could pull from that discount rate and be able to actually lend out money based on how many deposits they had. And if you've watched all the Silicon Valley Bank stuff happen, you kind of have an idea of how this works, right? Then we had the Great Depression and World War II, and during the Great Depression, the U.S. kept interest rates very low to stimulate the economy, and it also allowed them, because the rates were low, they were able to take on more government debt to actually pay for the war, and we took on a crazy amount of government debt during that time, although not as crazy as how much we have now. And for everybody that invested in these government bonds, and there'd be all these commercials of invest with Uncle Sam and support the war and support the U.S., And of course, by doing that, you were going to get interest back. You might put in $1 and get $1.10 back or $1.05 back over time. Now, interest rates remained relatively stable and low during the 1950s and 60s, but then we had inflation start to rear its ugly head in the 1970s. Price of gas was going up. There was a lot of uncertainty in the 70s. And so with higher inflation, of course, we all know what that means. Higher inflation means they started to raise interest rates. And then really in the 1980s, you had the Fed chairman Paul Volcker, and he really came on during the time of President Reagan, and he really raised interest rates higher. Ultimately, it did lead to inflation coming down and overall economic growth and a rebirth of the U.S. economy in the 1980s. Then you had interest rates come up into the 5.5% range that the Fed was out there. Mortgage rates were around 6.5%, 7%. I remember it well. And then you had 08-09 happen. And then when 08 and 09 happened, of course, interest rates went from the 5% range all the way down back to about 1% or 0.5% or even 0% in some cases. And those very low interest rates were kept superficially low, many economists say, from 2009 up until 2017, 18, 19, and then gradually interest rates came up a little bit. And then, of course, then we had COVID in 2020, and COVID happened. What happened with job losses? Job losses went up, business slowed down, we went into a slight recession. Those first 2 quarters of 2020 as people couldn't work. And then, of course, that led to, well, we better lower those interest rates. So interest rates came down. They were very low. There was too much government spending. And then 2022 happened, and inflation was not transitory. Sorry, Janet Yellen, it was not transitory. And so it went up. Jerome Powell, the Fed chairman, said, oh shit, we better start raising interest rates or inflation is going to eat everybody alive. Even though people were making slightly more money, inflation was so high that it was actually leaving people with less money to buy food, to take care of their families, and certainly cost of energy and homes and other things went up. And so then, over the last year, he has raised interest rates significantly, and in fact, just this last week raised interest rates again, another 1/4 point. And that, my friends, is the entire overarching history of interest rates. So what are your takeaways? Your takeaways are, I would say, understanding when it makes sense to pay interest and when it doesn't. I would say if you are buying a home and you have a long-term perspective, you're going to be there for a while, and you understand it's a place to live. It's not always an investment that goes straight up. Certainly it makes sense to get a mortgage on that. Most of us just don't have the cash to do that. And even if you did, you should be able to take that cash and make a much bigger return than whatever the mortgage interest rate is you're paying, even at 6.5%, 7%. Automobiles, same thing. The interest rates are usually low enough that you can make a bigger return with your money elsewhere instead of paying cash for the car. And then the other thing would be a business, because you can get a loan, pay some interest, and generate substantial 100, 200, 500% returns on that money as a business owner when you have proof of concept in your business, and generally that's the best return you're ever going to find. So that, my friends, in my opinion, is when it makes sense. Now, if you can, make the right investments into business, into cash flow real estate, into dividend stocks, then you should be earning interest yourself, and that's when you start to win. And Warren Buffett says when you can make money while you sleep, aka earn interest income from your business and investments without having to work it, that, my friends, is when interest works for you. And this is how this entire global economy works, and why technology and life has improved so much over the last several hundred years. Interest definitely played a pivotal role and was vital to make this happen. And that, my friends, is interest and how you can make it work for you. If you love this video, if you learned a lot, share it with others. And that, my friends, is the history of interest rates.